Good morning, everyone, and thanks for taking time today to join our monthly webinar. What a month this has been, a very volatile month. We will go through some of the issues that the markets faced. We will go through what happened in that month, and let's get right into it. Sunil, we will start with the US macro, and then I will follow up with portfolio specific stuff. Sunil, go ahead.
Shift to the first slide. Yeah. So as Ketu said, I'm going to cover the macro, and the big event of this month was obviously the FOMC meeting, where, as expected, there was a hold on the Fed funds rate. But as we will dive deeper into it, we'll see that it was not a very usual Fed meeting. Apart from this, there was a revival in the geopolitical volatility with the escalation in the US-Iran war and resultant energy price volatility. Right? So as you can see, Brent crude went all the way from 72 all the way up to 97, though subsequent to 23rd, there's been a little bit of easing back to the 90 levels. The other things in focus are the S&P 500 earnings. End of the day, economy matters, but stock market matters more. And for stock market, the earnings matters more. And as you can see from the headline, which we'll dig deeper later, is that there's actually an uptick for the S&P earnings expectation for this year from 24 to 27. So those were the big headlines. Let's dive deep into each one now. So as we move to the next slide, right, as I already said, there was a hold and the baseline expectation was for that. But the key thing was, this is Mr. Walt's first kind of meeting where he was chairing it. And the new chairs, there were 2-3 things which were very different from the usual. The first being, of course, there was a dissent, and the dissent was not in favor of a hold of a rate cut, but of a rate hike. Yeah, 3 of the members of the 12-member committee actually wanted to go ahead with a rate hike right away. Obviously, the energy inflation, which we just referred to, was a key factor in their decision making. Right. The second thing, I will go a little bit deeper into this expectation for the future. But the other thing about the press conference was that the new regime is clear about no forward guidance. And it's very clear that every action will be data dependent and that data can't be predicted and that you'll react as and when. Markets don't like this, right? Markets, equity markets especially, and to some extent the bond markets, try to read into the future. And you can, without getting that kind of a thing, and there were days, if you remember back, for those who have been tracking the markets for decades, you'll know even the raise of an eyebrow by Greenspan or Bonowitz were used to cause earthquakes in the market. To come to a completely opposite, where the Fed chair is evasive in his response, refusing to commit on what would be the conditions on which a rate hike would happen, what would the conditions the rate cut could be looked into, nothing of the sort. So the market is then swimming for results. And in fact, there was a curious thing which he said, is that, look, the movement in the 10-year yields is not any longer based on Fed. And he says that's market reading the data on its own and moving the yields. So which was like probably left the markets increasingly frustrated, right? And what happened is, post this, the Watch CME Fed Watch tool actually lowered the probability of a rate hike, despite a 3-member dissent, down from the earlier 78% to 57%. Now, what's not there in the slide is that parallelly the US GDP data came in, and that came in a bit softer than expected. So like Mr. Walsh himself was saying, the markets have to react to the data and not to any speeches or assessment by the Fed. The market will take some time to get used to, because now the Fed Watch tool, you have to rename the Fed Watch tool as a data watch tool, I guess, going forward. Moving on to the next slide. Ketul, can I?
Yeah.
Right, is of course the crude price issue, right? Now you can see here we have taken from January. So Feb 28th was a war. There was a huge spike to the $120 level. It stayed at a reasonably 100 plus level for a fairly 2 to 2.5 months. And then there was a ceasefire and cooling down of the thought processes, and it came down in the month of June to what, $72. Now the re-escalating tensions took it to 98, and I said subsequently to February, this is up to the 23rd of July. Subsequently, there's been easing. It's now Brent is back to around 90 levels, but that's still elevated. So this return of geopolitical risk premium, I think, is a key element to consider, because the markets had got into complacency saying this war is just like the Russia-Ukraine war, oil is stabilized, and let's see what happens. But clearly, Mr. Trump has upped the agenda back again, and now it's Iran which is taking the lead in escalating the tensions, attacking bases in Jordan, and if you remember, there was another complication with the Houthis getting into the act and attacking a Saudi Arabian tankers, because Saudi Arabia had this alternative west coast, route to taking out oil, and that also has come under trouble. So a mix of these geopolitical factors has. So as things stand, if you want to read the future on crude and the geopolitics, well, one take that I have is that Mr. Trump deals with 60-day periods. When the war started, he brought the ceasefire within 60 days. Now again, he's announced to the Congress that I'm restarting the war, I think it was 7th of July. Why this 60 days important is because no president can continue a war beyond 60 days without congressional approval. So he's just trying to avoid going to Congress and suffering a possible defeat in terms of the war continuance and closing it out. So now from July 7th, you're saying August 7th and September 7th is when this 60 days completes. So we have another month, whole month of August, where he will keep the war going in a way. And probably close to the September 7th, he might again come and say there's some cooling down and a talks and that. And who knows what he's going to do after that, because then you have the elections coming up in the midterm elections. So the uncertainty is here to stay. But like I said, Trump's actions to me seem to be driven a lot by how far can he get away by doing things without going to Congress for an approval. And that essentially increases the risk premium that the markets need, right? The Trump-induced volatility premium, if I may label it as such. So let's move forward to the next slide. We are now coming down to the hardcore data, right? Now, the point is that for all of this hype around the AI and everything else, it's important that we look at it from a US perspective, that the US economy is growing pretty strongly. And especially the manufacturing. Obviously, this has a link to the AI-driven capex that's started in a big way, and that is obviously contributing to this. But if you look at the surveys, now there are various regional surveys. On the right-hand side, the table gives you a summary of the ISM manufacturing PMI, the S&P is own PMI, and then you have the Empire State, the Philadelphia one, the Richmond one, the Dallas one, and the Kansas State. What's there? There's a lot of data, but clearly two things. If you see June shows uniformly it being well above 53 for almost every index there. In fact, Kansas City was at 56 almost. So clearly anything above 50 is an expansion. And what's interesting is that when you now got the July Empire State and Philly results have been announced, and they are even higher at 57 and 58. So clearly the US manufacturing cycle is on a strong expansionary mode. So the markets will naturally reflect that growth in some form or the other. So first of all, to underline, there's good news on US manufacturing, number one. Next. Now we come to the earnings. The heartbeat of the stock market is earnings. Remember, we kept talking, that this boom is not like the dot-com bubble. It's not a bubble. It's an AI earnings driven. Yes. So if you look at now at the earnings line, we have been talking to you all about the fact that earnings from S&P 500 is very, very high at 24%. We'll come to that in the next slide. But for this quarter, the earnings growth rate for this S&P is a fabulous 38%. So when we are, since we are in India, when talking about India, and we keep worrying about, 12% large cap earnings is, we're beating the expectations and all of that. You are comparing yourself to the market, which has shown a quarterly earnings growth of 38%, right? So if you look at it, right, the highest earning growth, if this actually comes out, this is the blended one right now, when the data actually comes out, if it really comes to 37.9, it'll be the highest earnings growth rate reported by the S&P 500 since Q3 of 2021. And what was Q3 2021? It was just post-COVID, coming off a low COVID base, it was at 40%. So you can clearly see that the AI-driven capex plus the energy prices. So as you'll see in the next slide, right? Semiconductors and energy are the top contributors to the S&P growth. Energy, because of prices increasing, US, mind you, is a net exporter of oil in all of this scenario. So there, if you see Micron Technology, you look at Alphabet, you look at each one of them, you're seeing that their earnings, they are the top five contributors to the 38% earnings growth we saw. So Micron is up there, Alphabet is up there, Chevron is there, ExxonMobil is there, and Nvidia is there. So you have a blend of tech, semiconductor, and energy there, which is driving the overall S&P 500 earnings, right? If you can go to the next slide now, and remember, we talked about what, $650 billion of capex, AI capex, just by the top 7 companies in the US, right? Now, despite that kind of a capex, profit margins are rising. Now, capex means that there's going to be interest costs and depreciation costs, right? But if you look at the EPS growth, it's able to match and beat that because there has been heavy borrowing for this capex also, and there's obviously depreciation as and things come on hold. Despite that, the S&P 500 net profit margins are on a rise. So really, we are talking about an economy which is on a fairly strong wicket, right? On the next slide, as we delve deeper into this, right? Now, as a result, market has upgraded the consensus forecast for this calendar year, which we are a little more than halfway through, from 24%, which we spoke last time when we did our webinar, to 27%. So the story is getting stronger, not weaker. That's the headline that we want to say. And if you look into the graph, and I'll go through it for you in a bit, energy is obviously the leader, communication services, information technology, materials is round about the same. S&P overall 500, as we said, it's 27 versus 24. So the ones on the left are the ones which have beaten the overall growth of the S&P, and the ones on the right are the ones which have not kept pace with that, but are broadly in line. The only place is healthcare, where the new revised estimate is less than the earlier estimate, right? That's the bottom end of the last right end of the x-axis of this graph. Otherwise, if you see, by and large, they have been stable, right? And in fact, financials have also had improved their earnings growth compared to the last quarter in terms of the one right after the S&P 500. So you can see that while, yes, energy and tech are contributing in a big way, almost every other sector is quarter on quarter on track, except for, as I said, healthcare. In terms of last quarter, the estimates for this year to now the revised estimates for this year from 24 to 27. So a good economic story is translating into a good earnings growth story too. So the next thing that we'll go into is that let's go forward now. Very soon the markets, in another couple of months, will start looking at the next year. They'll take this year as granted. So what's the outlook for 2027, right? The calendar year. A month earlier, they were expecting on the back of a higher base. You remember all these numbers are always YOY, right? So this year's very strong growth means next year you can't expect the same percentage growth terms because your base has gone up. So earlier we were expecting a consensus estimate of 15.3% EPS growth. That's also now been upgraded to 17.4%. So a 2.1. On the back of a 3% upgrade for this year, you have a 2.1% upgrade in earnings. But 17% earnings growth is also a very solid and more than justifies the current valuations that the S&P is trading at. Right? So as we move forward now, so on the conclusion, they will say the Fed is expected to be on extended pause on rate hikes because while oil-related inflation is rising, undoubtedly, the fact is that the US economy's growth came down a bit less than expected. And third is that the Fed also doesn't just look at headline inflation, they look at core, which excludes food and energy. So that's the real inflation which will tempt them. So the geopolitical related oil crisis will prevent a rate cut because they don't want to fuel inflation on the demand side. But whether it will on its own cause a rate hike is not so clear because they tend to ignore energy and food and look at what is called as core inflation. So that's why we are saying that what is likely to be an extended pause on the rate hikes. Second, we just discussed in detail, simplified earnings growth is one of the best we have seen post-COVID. And of course, to turn round it off, geopolitical uncertainty and elevated crude price remain the two factors which weigh on global equity markets. With that, I have completed my US macro overview, and over to you, Ketal, to take you down into the more nitty-gritty details of the portfolio as well as the sectors.
Thank you, Sunil. So this month, I think, especially on the semiconductor side, it was dominated by China. There were multiple announcements that came out of China which hurt the semiconductor space altogether. The first one was the Kim K3 LLM. Initially, when they announced it, it was mentioned that they are one of the cheapest LLM out there. But as market did more research into it, it does turn out that their cost per task is fairly in line with what a ChatGPT's cost per task is, or even more than what Gemini, which is Google's LLM, cost per task is. Now, another important thing whenever such LLM stories come out for everybody to remember is that Chinese LLM models are open source models, which means that their innovations are copied by their US competitors within 1 or 2 days. It's not a big deal at all. And so, as far as reducing the cost is concerned, it's good and it helps everybody because as the cost of AI and LLMs decrease, the usage will just increase. And a very easy example for you to refer to is when the mobile telephony was new. You remember each minute used to cost 20 rupees, 30 rupees per minute. And at that time, the usage was quite low. But as soon as the mobile telephony's cost declined, the usage grew by leaps and bounds. I think something similar will happen on the LLM and AI side also. Right now, the access to LLMs and AI is only available to people who can afford it, but democratization of LLMs is happening as we speak. And so anytime there is news about a lower cost LLM model from China, it's actually a positive for the industry because these LLMs are actually a cost, believe it or not, for companies like Google, Amazon, and Microsoft. Google has their own LLM, but Amazon and Microsoft don't have their own LLMs, right? So for these guys, it is a cost actually, which they pass on to their customers. Simple as that. So if they're passing on a lower cost to their customers will be more than happy to increase their usage. And that's why I think whenever there is an announcement of a cheaper Chinese LLM in the market, that should not be taken as a negative. But markets being market, I think everybody in the market shoots first and asks questions later type of mentality. And that is why the market sold off post this announcement. Another concern was about the hyperscaler capex and an announcement coming out of China again that they had developed lithography machines which were going to compete with ASML. And ASML is the only company which can make lithography machines, and these lithography machines are primarily used for semiconductor manufacturing. These machines are huge. You need multiple chartered jumbo jets to transfer these machines to wherever they are going to be installed. They cost $300 to $400 million each. And that's why only one company in the world is able to produce it. China announced that they have now reached a state where they are beginning to make the lower end of these machines. And anyways, I think one should always assume that if there is one company in the world that is making it, there will be more companies that will enter the competition and make these machines. So that also weighed on the markets during the month of July. Add on to that, the geopolitical uncertainty from the increase in crude oil prices did not help. And so all these factors put together, we saw a massive volatility. And because of this, a lot of leveraged bets. There were a lot of leveraged ETFs in Korea, a hedge fund based out of New York, which was highly levered to semiconductor, blew up, and all these were technical factors. There's no fundamental change in the story of AI or the usage of AI or the growth of AI. These are purely technical factors which happened because of unrelated issues, and that's why we were very confident that these are technical issues, and as soon as these issues go away, the markets will recover. And you get these issues every once in 12 to 18 months, you get this. Last time we saw such issues was in March when the US-Iran war was announced. At that time, there were DeepSeek was a Chinese LLM model that was also announced roughly at the same time. So those two factors caused the market to crash briefly for a month or so, but after that, the markets recovered. So again, whenever there are such technical pullbacks, we always believe that if you have the capacity to uh, go through it and come out, on the other side, maintaining your positions and in fact increasing your positions, then you will do very well. People who have taken leverage, like the hedge fund in New York that blew up, or the leveraged ETFs in out of South Korea, they cannot sustain such volatility, and so they have to book their losses, and they cannot continue participating in the upside that follows such volatility. And that is why we feel that you get such chances every once in 12 to 18 months. And this would be a very good time to add more money if you already have it, or initiate new position if you haven't already done so. These chances, they don't last for more than a week or two, because the markets these days, they react to news fairly quickly, and they go down also fast and come back up also equally quickly. So we do feel that this is a good time to add more money if you haven't already done so. Another issue that we have seen in the market was the hyperscaler capex concerns. Now, these capex concerns have been coming from the fact that Amazon, Microsoft, and Google, these are the three hyperscalers, they are spending roughly close to 800 billion to $1 trillion per year in capex. However, market reaction to Amazon and Microsoft earnings in the last week are showing now that those concerns are now ebbing. The reason for that is that they are seeing that these companies, while they are doing capex, they are also generating a lot of cash flow, a lot of EBIT. Their EBIT margins are in the range of 30 to 40%. So if you are spending on something that is going to give you 30 to 40% EBIT margins, that is not wrong. The market is slowly coming around to that idea, and the reaction to Amazon and Microsoft's post earnings stock prices, which were up roughly 15%, each one of them, shows that the market is realizing that. And now, another thing that we will quickly see is that now this capex has been going on for 1 year, which means that the earnings from that will start showing up. And you saw that in each one of them, Google, Microsoft, Amazon, each one of them grew somewhere between 40 to 80% in their AI infrastructure business. Their revenues grew anywhere from 40 to 80%. So the capex that they had done last year, they are doing this year, is now showing its impact in the earnings and revenue part. And as soon as you start seeing that impact, I think the markets realize that these are massive, massive earnings generators, and that's why the market is coming back to now appreciating that fact. Power has always been a big factor. We do believe that the power requirement for AI data centers is massive. This chart over here gives you the amount of new power that is required. Just to give you an idea as a reference point, India is roughly 300 gigawatts in total of conventional power generation capacity that we have, and this we built, for the past 75 to 100 years. US needs that much amount of additional power by the end of 2029 just for data centers. So you can imagine the entire conventional power capacity of India is required to be added to the US by 2029. So that's a huge amount, and I think power is the sector where you will see the next bottleneck happening in the AI story. We always get this question, is AI in a bubble? So we try to address it as many times as possible. You will see on the top right-hand side chart, the Cisco EPS and stock price in the 1998 to 2002 tech bubble. You can see the stock price went up way higher. The earnings, the red line, did not keep up with the stock price. But that is not the case with the, say, Nvidia right now. In fact, it is the reverse. The earnings have gone up parabolic, if you can see over there on the right hand side bottom chart, versus the stock price has not kept pace. So whenever such things are happening, we are never worried about a bubble because there is always an earning support. If Nvidia falls by 10% today, it will be trading at 17 times, 16 times PE multiples, right? So immediately there will be support. A bubble is when there is no support on the downside. Here you will immediately see support because the valuations are so cheap. And that's why we are not worried about a bubble so far. This is the AI capex. We already discussed that. These are some of the AI builders. And you will see that all of them, their cash flow margins are declining because they are doing a lot of capex. Now, obviously, when you're spending money for future assets, then your cash flow margins will decline. And that's what the market was worried about. But this is the EBIT margins that I was talking about. We have it from the at the beginning of 2023 when the AI boom started. Google's cloud business, which is the AI infrastructure business, which is doing all this capex, they're doing roughly in the range of 200 to 220 billion dollars of capex every year. Their margin was 2.6% EBIT margins. Now it is actually 30. This we have data which is slightly old from 2025, but yeah, it has gone from 2.6% to 30% EBIT margins over the last 3 years. So you can imagine, in spite of spending so much capex, Google is able to consistently increase its EBIT margin. So there's nothing to worry about their AI capex. One more, something that we always look at, the earnings momentum. The earnings momentum is very positive. The top line is the 2027 S&P 500 earnings estimates, and the bottom line is the CY 2026. You can see that in the last 1.5 years, both of them have continuously increased. So this shows that compared to last year or compared to beginning of this year, the earnings estimate for 26 and 27 have been on an upward trajectory, which means the market is continuously increasing the earnings estimate for the S&P 500 for calendar year 26 and 27 for the last 1.5 year. So that's very good earnings momentum. As long as this earnings momentum continues, we are not too much worried about the technical factors that happen in between. Another thing, we always get this question that if the stock markets are at an all-time high, then how are they not expensive? Because we are used to a liquidity rally. What we saw in India and other places around the world was a liquidity rally, which means the earnings did not keep pace with the stock prices. So the blue line and the black line, the blue line is the stock prices, the black line is the earnings. In US, it is a fundamentally supported story because the stock prices and the earnings have kept pace for the last 10 years or 11 years. This is from 2015. And whenever you have a rally which is supported by earnings, that is natural. That is how mathematics works, right? If earnings grow, the stock prices will react. And so, in spite of the market being at an all-time high, the valuations are not stretched at all. And that's why we feel very confident in investing more in this market also. In fact, if you compare the semiconductor and the healthcare, as Sunil had mentioned in his slides, that healthcare was the lowest growth sector versus semiconductor was the highest growth sector. Currently, the valuation of the lowest growth sector and the highest growth sector is at the exact same level on a forward PE multiple basis. So you rarely see such opportunities where the highest growth sector is trading like the lowest growth sector. The blue line is the forward earnings multiple for the S&P 500 semiconductor sector, and the white line is the S&P healthcare sector forward 12-month PE multiple. They are trading at exactly the same levels. Now, this could happen only if you think that the semiconductors are cyclical and we are at the tail end of that cycle. If you are at the tail end of that cycle, then this worry could be justified. But we are nowhere close to the tail end of the cycle because the consumers of the semiconductors, the Google, the Microsoft, the Amazons of the world, they are increasing their capex from 800 billion to $1 trillion next year. So you are not even close to the tail end. So I think these valuations are not justified, and the semiconductor sector will recover from this point on. These are some of the individual stock valuation. They are also again at all-time lows. And yeah, I think that is pretty much it. Now we'll take the questions. If you have any questions, please type them in the Q&A box or the chat box, and Suman or Prashant from our team will be able to read out those questions.
I see one question there from Shivshankar. I think we addressed it, Ketul. He says, Christopher Wood of Jefferies says cheaper Chinese AI models may lead to capital destruction for American AI companies. Your comments?
Yes, so I think capital destruction happens for companies that have invested it for 3 to 5 years. So some of the investments that we are talking about is being done by Google, Microsoft, and Amazon primarily, and they are actually consumers of cheaper models. Now, capital destruction can happen at Anthropic and OpenAI. That is fair. That's a fair argument. But neither Anthropic nor OpenAI is a public company. Nobody's invested in those stocks. They are privately funded companies, and such things are normal. I mean, all companies don't make money. There is competition. You will fight. Some companies will survive. Some companies will die. But the companies that we are looking at, the publicly listed companies, nobody's capital is being destroyed because of cheap Chinese LLMs. In fact, they will be the beneficiary because they will use those models. So if you go to Microsoft today, they offer Chinese models. If you go to Amazon today, they offer Chinese models. If you want a lower cost, slightly lower quality, you can use the Chinese model, which is open source, and run your AI queries through them. They will just pass on that cost to you. So if you are running a Chinese model, it will be cheaper. And so for Microsoft, it is immaterial. They keep their margin. They are providing the infrastructure. And so think of it as a toll road, right? If the price of crude oil goes down, the number of cars passing through the toll road will increase because people will travel more. But that doesn't mean the toll road is going to reduce their tolls. The tolls will stay the same in spite of the price of crude oil declining. So actually their volumes will increase because more people will use it. There's another question which is, what is the average depreciation period for capex for hyperscalers? Typically it is between 5 to 6 years. At one point in time, it was 3 to 4 years also. They increased it to 5 to 6 years because of the humongous demand that they had. So if think of it as a car company. If you go and try to rent a car from a car rental company, the most latest models, they will rent you at a higher cost. But the slightly used models, they will rent it to you at a lower cost also. And that is why the demand for chips and the demand for data centers is so high that those servers that were outdated and being used only for 3 to 4 years, now because you are not getting access to those servers, now people are extending those life to 5 to 6 years. And that is why depreciation for these servers have been increased from 3, 4 years to 5 to 6 years. What percentage of our portfolio is currently invested in which countries? So our ideal idea would be to invest 25 to 30% in non-US stocks. what has happened over, we started with that. What has happened is that the US stocks did so well that just because of mark to market, that 25% of international stocks went down to about 15% or so. But that is not, it was not by design, it was just happened because of mark to market. But when the US stocks are doing so strong and mark to market is doing so well, we will let it run. We don't have to be at 25% or 30% in international stocks. We try to get it to that point, but because of mark to market, if they change, then we are fine with that.
So, sir, we have one more question.
Yes.
So basically, the question is, which structural theme do you believe will outperform over the next 5 to 10 years beyond AI?
Beyond
Okay.
AI.
Yes, so definitely. So AI is one. The next themes that some of the themes that we are looking at is aerospace. SpaceX was a good example that we saw in the last 1 month or so. They went IPO at a $1.7 trillion valuation. So space exploration is one of the things that we are looking at very actively, and that's, I think, the space where there will be a lot of growth in the next few years. The reason for that is so far all the cell phones that we use are terrestrial, which means the signals come from a tower that is located in your neighborhood. Within 3 to 4 kilometers, there has to be a tower which is giving signals to your cell phone. This is about to change. In the next 3 to 5 years, you are most likely going to use signals directly from a satellite because of something called the LEO, low Earth orbital satellites, because of which these satellites are going around the Earth very close to the Earth at about 200 to 300 kilometers versus the geospatial satellites, which used to be 3,000 kilometers away. And that is why the latency has decreased, the power consumption has decreased, and they are now commercially viable to have cell phones, and which means you will not have to worry about the towers or you will not have to worry about signals anywhere in the world. This is going to be a reality in the next 5 years, and for this you need massive amounts of satellites going around the world, and each satellite costs about $20 million today. So if you assume 7,000, 8,000 satellites launched every year, then these numbers are just humongous. So I think that's one space where we are seeing tremendous growth. Drones and anti-drones is another space that we are seeing tremendous growth. As you saw with the war in Ukraine, a small country like Ukraine was able to fight Russia because of drones. So everybody realizes drones are the uh, next, I think, the, the newest battlefield equipments that everybody will require. And counter drones, because now you have drones, now you need something to counter drones, counter UAS as they are called. This will be required not only for your battlefields, it will be required anywhere there is a concert, there is a public gathering going on, because you don't want drones as a security threat to your public gatherings. So this is another space where we are seeing a lot of innovation going on. Another space is reducing healthcare costs. Healthcare costs in the US have increased to an extent where they are not feasible economically for a lot of consumers. So any company that is able to reduce those healthcare costs is another space where we are seeing a lot of growth. So these are some of the sectors where we are seeing interesting opportunities.
So we have a next question also. Hello.
Yes, yes, go
So
ahead.
the
We can
next
hear you.
next question is Nvidia's earnings are strong right now, mostly because it has a near monopoly in GPUs. But Google, Amazon, Microsoft are building their own chips, which could challenge that over time. There is also a growing worry about whether AI is an actually worth the money com- companies are spending on it. And I don't think we will know for sure for other 2 3 years if AI doesn't live up to the hype. Could that cause a big drop in the stock prices of Nvidia and the big tech companies? What do you think?
Yes. So see, as we saw, this is not, we are not going to get the financial results after 2, 3 years. We are getting it every quarter. The margins of the cloud businesses are growing. As we showed in our slide, Google's cloud business margins, EBIT margins, and this is after depreciation. We are talking about EBIT margins, not EBITDA. So after deducting depreciation, EBIT margins, they went from 2.3% at the beginning of the AI boom in 2023 to somewhere around 30% right now. So the margins are growing. So there is no reason for them to, or for anybody to worry about if companies are making money. They are making money hand over fist. And that is why you saw the reaction that you saw with Microsoft and Amazon's stock price going up 15%, because now the market is understanding that the doubts that they had about capex plans and whether they will make money or not are with these results. Now they are coming around to the idea that no, they are making money. It is not a problem. So we don't think that's a problem. And Google and Microsoft and all these guys having their own chips, that's a natural extension. They are such big consumers that they would want to tailor something to their own usage. For NVIDIA, it is not a problem because Google is tailoring something for their own usage, which means other people cannot use it. It cannot be used outside of Google. Maybe at one or two places, but it is not a general purpose GPU because it is specific to Google. The type of workload that Google has, it works for them, but it doesn't work for everything. And that is why when somebody comes up with a competing GPU to NVIDIA, it's not an issue for NVIDIA because that is made for that specific purpose. It's not made for general purpose. And that's why we are not too worried about it.
So the next question is, sir, power is the next thing, and the space technology is also next. Then which stocks are you in your portfolio?
Yes, so we generally don't discuss individual stocks, but we do have power companies in our portfolio. We do have aerospace companies also in our portfolio. Now, they are not big right now because that whole sector as such is a small part of the total market cap of the world. But as those sectors grow, you can be rest assured they will grow in our portfolio as well. Right now, they are both of them are less than 5%, but as these applications grow and as we see more revenues coming out of this, we will be increasing allocation to these sectors.
So we have another question. What is the taxation on the profit?
Taxation for our portfolio is very simple. It is 12.5% LTCG above 2 years, and any capital gains below 2 years goes into the regular income. So your tax will be your marginal tax bracket. In US, there is no taxes for foreign residents, so there is no tax, there is no capital gains for anybody investing from India or any other country in the world into the US. So no taxes, no TDS, nothing to be filed in the US. Only in India, you have to pay taxes of 12.5% LTCG after 2 years, and it is considered regular income for any capital gains in less than 2 years.
So we have another question. APEC, Indonesia, Malaysia, Vietnam, Thailand, percentage of investment, and please overview of this country.
So over there we have about, I think, 4% or so in the APEC region. And we do feel these are the China plus one growth stories. So we have invested in, but these are typical emerging market type of scenarios. So you have to invest in consumers, you have to invest in credit growth, you have to invest in consumption. So we have invested in companies that are a combination or are a part of this consumer credit growth type of a story.
That's all. So
That's all?
we don't have any more questions.
Okay. Right then.
Okay.
Thank you.
Thank you, Sunil. Thank you, everyone, for joining the conference today. We look forward to seeing you in the next monthly conference call on the first Saturday of next month. Thank you very much. Have a nice day. Bye bye.